Digital BTBT is no longer just a typical crypto mining related equity. It is increasingly positioning itself as an Ethereum treasury and staking focused public company in the United States, listed on NASDAQ. The headline metrics can look strangely attractive at first glance, and that is exactly where experienced investors start to feel uneasy. When valuation ratios and earnings figures look too clean, the first question is not how much upside is left. The first question is what kind of earnings these are and whether they can repeat. One reason the story feels suspicious is the relationship between revenue and net income. In many ordinary businesses, revenue is larger and profit is what remains after costs. When net income appears to rival or even exceed revenue, a common explanation is that the profit is not coming from selling products or services. It can come from gains tied to asset prices, the kind of gains that look great on paper when markets rise and can reverse sharply when markets fall. That distinction matters because investors are not just buying a number, they are buying the engine that produces the number. That concern becomes more concrete when the company frames performance in ways that can include digital asset-related gains. In 2025 Q3 materials released on November 14, 2025, the broader message is that reported strength can be supported by digital asset appreciation. In plain terms, that means a portion of the performance may be linked to the market value of assets the company holds rather than operating cash flow generated by a stable customer business. When that happens, traditional valuation signals like a low PE can become a mirage. The multiple may be low because the earnings base is not the kind investors can count on quarter after quarter. Then comes the bigger mystery. The company has been emphasizing an institutional-grade Ethereum treasury and staking model. Treasury normally means a corporate cash box, and the usual playbook for a listed company is simple. Keep liquidity in cash and safe instruments, then funnel capital into the core business through research, expansion, or acquisitions to grow future cash flow. Digital is drifting away from that familiar playbook and leaning into Ethereum holdings as a central pillar of its identity. That shift matters because it ties the equity more directly to an external variable the company cannot control, the price of Ethereum. The timeline makes this shift hard to ignore. On September 30th, 2025, the company announced a convertible notes offering, roughly $135 million, with maturity in 2030. Convertible notes are typically used by growth-oriented companies to raise capital for operating expansion, things like building capacity, acquiring businesses, or funding product development. That is the standard path.